get into a product, get into a specific product, how it works, how to describe it. What we're going to do is I was talking to some partners, some of our partners here, and our leadership. And as we were trying to decide, okay, how are we going to do these webinars that can be the most effective for our agents, for the people that watch them. And so what we're going to do the first few, and we've already got the one for today, the 13th, which is Thursday, the 18th, which is next Tuesday, and then the 20th, which is the following Thursday, broken down into what we're going to talk about, the simple principle, and then getting into a specific product. And we thought that it would be advantageous, since it is September. September is Life Insurance Awareness Month, that we talk about life insurance for the month of September. So not the most traditional place to start, but in honor of Life Insurance Awareness Month. It's interesting. I was reading just yesterday, actually, that 41% of people have no life insurance. 41% have no life insurance, but of those that do, those other 60%, only a third, 1/3 of them only have coverage through work. Even if people are fully covered at work, it's a good idea to get an independent, self-owned life insurance policy, because how long are they going to work there? Is it guaranteed that they're going to continue to work there the rest of their career? And people may say, well, what if I go to my new job and they give me life insurance? Well, is that a guarantee? Is it guaranteed that you're going to work there forever? Is it guaranteed if you leave and you go somewhere else that you're going to get coverage where you're at? But then in a lot of ways, what's happening with employer plans and the cost of taxes for employers and benefits for employers and salaries for employers, they look at, do we pay this guy more, or do we invest in research and development, or do we give people a little term life policy? And sometimes it's very competitive to just not have the group plan at all and just get your own independent policy that you can take with you anywhere you go. Whether you work there or not, get laid off or not, the new company has it or not, if you have your own policy, you take that everywhere you go. But the age-old question is, what's the best type? What's the right type for me? Am I paying too much? Am I paying not enough? And there's a million opinions out there, but we're talking about real world how stuff works without a specific biased opinion being limited to the products that we can offer, which, shameless plug for doing business with the right people is actually not shameless at all, is to do business with people that have options, that can look. And so you talk to people and you ask them, if I was to ask you right now to get out a piece of paper and write down how many different types of life insurance there are, how many are there? If you ask that question to 10, 15, 20 people, I would imagine they're going to say two. There's term and there's whole life. And that's what people are familiar with. Well, what if I said over the next 4 weeks, we would be able to talk about 3 different policies per episode for the next 4 episodes? Well, how many does that add up to? That adds up to 12, doesn't it? Because let me look at my list. 1, 2, 3, 4, 5, 6, 7, 8, 9. So just on my list that I made earlier today, I have 11 different types, and I'm already seeing one that's not on the list that we'll be covering over the next several weeks. So we're going to, again, just start with the conceptual basics of life insurance. And then after we do the conceptual over the next 4 weeks, is we'll get into specific products, whether it's a Transamerica or a Prudential or Protective or Gerber, or there's so many different types that we said let's start with basics and then grow on top of the basics. So what we're going to talk about today are three different types. Number 1 is going to be level term. Number 2 is going to be increasing term. And number 3 is going to be decreasing term. Level term, increasing term, decreasing term. And we'll cover those, and then Again, in future episodes later on this month, we'll talk about specific companies, specific products that can do each of these. But first of all, there's a lot of questions of, well, why should I get life insurance? Why do I need it? The concept we'll be talking about next time is something called the DIME method and several other ways that people determine how much coverage they need. But let's just talk about these quickly. Level term. What does level term mean? Well, that can depend. There's two pieces of a term policy or insurance in general. Is you have your death benefit, and that's your total coverage. If my death benefit is $200,000 and I die, whoever my beneficiary is, which in this case is my wife, she would get $200,000, right? Then I have my premium. Okay, and my premium is what I pay every month for the policy, or every quarter, or every 6 months, or every year. And so the less frequently I pay, meaning a year would be the least frequent, that's the least expensive. So it's actually less expensive 99 times out of 100 to pay the annual premium than it is to pay monthly. So you have to think from the life insurance company's point of view, that saves them money, monthly maintenance, and they're getting more money up front that they can then invest and start earning interest on, and so that's why they charge the client less, a smaller premium. And so in a level term, you have a level death benefit, and you have a level premium. Level meaning it doesn't change. So the death benefit stays the same the whole time we have it. The premium stays the same the whole time we have it. And there's multiple different types of level term. You can actually get a 1-year term policy. It's a very specialized type of term insurance, but you can get a 1-year term policy. You can get a 5-year term policy. These are the most common ones. 1 and 5 are kind of interesting. But the most common ones, you have 10, 15, 20-year, 25-year, and 30-year. And some companies have even gone on and done a 35-year level term policy. Which means what? It means that I get a policy, I pick my death benefit, the insurance company underwrites it, gives me my premium, and tells me your premium will not change for 10 years based on your health. So at the end of 10 years, what do I do? Well, I have a couple of options. I can either renew this, that we'll talk about on another episode, or I can just get a new one. If I get a new one, I have to get a new one based on my new age 10 years later. And even if my health is exactly the same, height and weight is exactly the same, it's going to be more just because I'm older. Well, why is it more because I'm older? Well, because if I'm 34 today, and in 10 years from now I'm 44, I'm closer to death, according to life insurance actuaries, I'm closer to death at 44 than I am at 34, therefore they charge me more. Okay? Let's just give an example, a $250,000 policy, and this is in no way quoting any specific company, just to give you an idea. If I was to get a $250,000 10-year term on myself, 34 years old, $250,000, a 10-year policy, just from doing a few of these, I bet it would be between $15 and $18 a month. Okay? If I was to get a 15-year, it would be probably $20 to $25 a month. Because it's going to last longer, the insurance company needs to get more money to put in the big pool, so if any other 34-year-old like me just so happens to pass away, they can pay out that death benefit. The 20-year is going to be a little bit more, 25 to 30, 30 to 40, 40 to 50 on the 30-year. So basically, the longer the term is, in most cases, the longer the term, the higher the premium in a level policy. So as I pay, I have the predictability in my monthly budget. I just pay the same amount every month for the period of time that I choose. And then if I pass away in that window, the $250,000 goes to my beneficiaries. If I don't pass away, then I get to the end and I have to decide whether I turn it into a renewable term policy, annual renewable term, and that's the one I forgot. I'm going to add it to my list. Don't go anywhere. Okay, good. Glad you didn't go anywhere. Annual renewable term. So now we're at 12. 12 different types of insurance, not 2, right? Is I can decide to convert it, and so I don't have to re-qualify, or I just get a new one. Well, if I get a new one, it could potentially cost more, or my health could be in a situation where I don't qualify at a preferred rating, and rate classes. We'll make sure that we talk about that and some of the differences and look at some quotes and things like that. And this is going to be huge. This is just basic financial information on life insurance for you and to share. So increasing term, how does that work? Well, it depends. Just like we have here, we have our death benefit and our premium. And I've seen it both ways. I've seen where basically an increasing term policy means that I start with a $250,000 death benefit, but over time, that death benefit increases. And so the concept there is, well, with inflation, if everything in the future costs more and I die in the future, what my need for insurance today is, it might be more in the future as I earn more, as I get more assets. You know, one of the things, one of the principles of life insurance out there, and what some insurance agents will tell you, is that the older you get, the less insurance you need. Is that always true? No, it's not always true. In a lot of cases I've seen, the older people get, the more life insurance they need because of inflation and assets and income and all of those things. But, so let's say someone wants an increasing term. They get the death benefit that starts here, it increases over time, and then their premium, so this is the death benefit, DB, and then the premium could do one of two things, and I've seen it both ways, where it's a level premium, so that it's predictable that we pay the same, but the death benefit's going to go up. But because it's going to go up in the future, we would pay a higher premium than just a regular level death benefit, regular level premium, which you think about it, it makes sense. The most common that I've seen will, however, will have an increasing premium as well. Increasing death benefit, increasing premium. The bigger the death benefit gets, the more we pay for that insurance, and most of them do that on an annual basis. This year I pay 20, next year I pay 22, the next year I pay 24, the next year I pay 27, et cetera, and my benefit increases. But as you know, doing this for a long time, one thing that I know a lot of people don't like is having variable expenses. They like, put it on automatic, it's the same every month, it's predictable. Could it save them money long term to do this? Maybe. But again, we're humans. We deal with humans. We're going to talk to humans about this, and they're the ones that have to maintain the plan, and most humans like to have predictable expenses. Okay? So that's increasing term. Is this very common? Do you see this a lot? Not really. This is probably the one that you see the most when it comes to term insurance. Okay, decreasing term. How does that work? The most common here is going to be companies that once you get a mortgage, if you've ever bought a new home, you start getting bombarded with a whole bunch of mailers that talk about getting life insurance, a mortgage life insurance that's attached to the side of your mortgage, and you think that it's something that the mortgage company is offering, and it's not. It's just a way that life insurance companies who don't know how to prospect and don't know how to get referrals mass mail and try to get business that way. I'm not saying that it doesn't work. It's just send out 1,000, get 10 back, and if that's the model they run and it works, then high five. It's not the way I run my business, but so basically what it is if I have a house that I buy is $300,000 and I get a life insurance policy that parallels that, a decreasing term that parallels that, then as my mortgage balance goes down, so does the death benefit of my life insurance. So very simple, it's basically a coverage that basically has the opposite argument of this one. Is that someone feels that over time their need for insurance is going to go down, and in some cases they're right. I'm not saying that's wrong, and in some cases people say that the need goes up, and so they get an increasing, and some get decreasing, and it basically goes down over time. The most common ones that I've seen when it comes to death benefit and premium is the death benefit goes down, and the premium of most of the ones that I've seen stays the same. So it has a level premium where they're paying the same every month, but then it goes down. Then the death benefit goes down over time. Premium stays the same. So that's episode 1. Episode 1, what did we cover? Number 1 is we covered what the purpose of the Impact School of Money is, how it can serve you, how it can serve your potential clients, and how will be, future, and this is just talking vision, is clipping out little pieces of these and making them 1-minute segments or 2 3-minute segments that we can then, be the ones that are compliant, post them on social media to just start getting, a little bit more attention and letting people see really that we're here to educate. We're here to help people understand how money works, how life insurance works, how taxes work, how retirement works, how long-term care works, how all these different things work. We went over what the School of Impact School of Money is. We went over the wealth formula and understanding money and how it works, and it doesn't matter what you have on a statement, it matters what you get to spend, what your actual spendable dollars are, and how to maximize that. And then we went over 3 of the 12 different types of insurance, which is how long our list is now, it might grow. 3 different types of life insurance. Look forward to future episodes. Hope you got value from this, and we'll see you again Thursday morning.